Welcome to this Nedbank Financial Market educational series proudly brought to you by our online share trading division. In this educational series, we will discuss various topics related to financial markets. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there's more to this than meets the eye. In this session, we will discuss a brief history of the Johannesburg Securities Exchange, commonly referred to as the JSE. We will highlight the benefits of listing a company on the JSE and will answer the questions of why companies list on an exchange. We will also discuss some aspects of what it means to be a shareholder, look at different types of shareholders, corporate actions, and the objectives of the JSE-CONTINUED announcements. Please note that this session is on both a beginner and intermediate level. Before we begin, please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it has been provided for educational purposes only. Let us commence the session. The Johannesburg Stock Exchange is also known as the JSE. It was founded by Benjamin Willin on the 8th of November 1887 during the first South African gold rush. Following the first legislation covering financial markets in 1947, the JSE joined the World Federation of Exchanges in 1963. It upgraded to an electronic trading system in the early 1990s. The bourse demutualized and listed on its own exchange in 2005. The JSE Securities Exchange, and now the Johannesburg Stock Exchange, is the largest stock exchange in Africa. In 2003, they launched an alternative exchange, AltX, for small and mid-sized listings, followed by YieldX for interest rate and currency instruments. The JSE acquired the South African Futures Exchange, or SAFEX, in 2001, and the Bond Exchange of South Africa, or BISA, in 2009. Today, they offer 5 financial markets, namely equities, bonds, financial, commodity, and interest rate derivatives. Now let's discuss the benefits of listing a company on the JSE. Listing is the process of taking a privately owned organization and making the transition to a publicly owned entity whose shares can be traded on a stock exchange. The benefit of having shares traded on a stock exchange is central to an organization's decision to list. The fundamental role of the JSE is to bring together in one marketplace providers of capital and organizations that require capital. The JSE undertakes this role in South Africa and as such acts as a hub at the center of the South African economy. Providers of capital earn a return on their investments through dividends and capital growth, thereby increasing the overall wealth of the nation, while the organizations in which they invest provide jobs and drive the economic development of the country. As Africa's oldest stock exchange, the JSE has been listing companies, trusts and other products for more than 115 years, so the benefits are well known to the market. These benefits include the following. Capital growth. Listing provides opportunities to both the listing company and an investor. The listed entity finds an opportunity to raise primary capital to fund acquisitions or organic growth in the market, while the investors grow their savings through share price fluctuations as well as capital income in the form of dividends. The elevation of corporate profile. Listing generally raises your organization's public profile with customers, suppliers, investors, and the media. Listed entities usually get to be covered in analyst reports and may be included in an index. Institutional investment. Public listing means your organization will find it easier to attract institutional funds, that is, other companies wishing to invest in your company. This can provide availability of both capital and expertise and professional investors. Improved valuation. Being listed generates an independent valuation of your organization by the market. Trading platform for issued shares. The JSE provides an ideal trading platform for your shares and also gives shareholders the opportunity to realize the value of their holdings, which in turn can help broaden your shareholder base. Exit strategy for early investors. Listing provides a mechanism for founders of the company, family interests, or early stage investors to exit their investment. Alignment of employee management interests. The process of remunerating your employees, executives, and directors with shares is simplified, making it easier to align the interests of your employees with the goals of your organization. reassurance of customers and suppliers. Organizations listed on the JSE generally find that the perception of their financial and business strength is improved. Let's have a closer look at why companies list on the JSE. Traders and investors are familiar with the process of buying and selling shares on the JSE, but why would a company list on the stock exchange in the first place? One of the main reasons why a company lists on a stock exchange is to raise capital to grow the business. There is usually a capital target with a set number of shares available to reach that target. The company may need the capital injection for product and software development or to expand its service offering abroad. Companies could also be considering some small acquisitions and could be allocating some of the cash to their marketing budget. A private placement is an offer of shares to a select group of investors at a set price. Private placements are usually large banks, mutual funds, insurance companies, and pension funds. A public issue, on the other hand, allows anyone to buy shares on the open market at market-determined prices. When you buy shares on the JSE, you're effectively buying public issue shares. A high demand for shares will force prices to increase. A listing attracts local analyst coverage and media interest, enhancing the company's reputation and profile. This in turn enhances their ability to attract talent by offering share option incentives. A listing can also facilitate broad-based economic empowerment deals. Listing stimulates liquidity, giving shareholders the opportunity to realize the value of their investments. It allows shareholders to transact in the shares of the company, sharing risks as well as benefiting from any increase in the organization's value. We're going to deviate a little now and discuss the concept of what it means to be a shareholder. A shareholder, also referred to as a stockholder, is a person, company, or institution that owns at least one share of a company's shares. Shareholders also enjoy certain rights, such as voting at shareholder meetings to approve things like board members, dividend distributions, or mergers. Because shareholders are essentially owners in a company, they reap the benefit of the business's success. These rewards come in the form of increased share valuations or as financial profits distributed as dividends. Conversely, when a company loses money, the share price invariably drops, which can cause shareholders to lose money or suffer declines in their portfolio values. Companies can have both majority and minority shareholders. A single shareholder who owns and controls more than 50% of a company's outstanding shares is known as a majority shareholder. Some companies have only one shareholder. These single shareholder companies are often company founder run. By controlling more than half of a company's voting interest, majority shareholders obtain considerable power to influence key operational decisions, including the placement of board members and C-level executives like chief executive officers, CFOs, and other senior personnel. For this reason, companies often attempt to avoid having majority shareholders amongst their ranks. Those who hold less than 50% of a company's shares are classified as minority shareholders. Unlike the owners of sole proprietorships or partnerships, shareholders of listed companies are not personally liable for the company's debts and other financial obligations. Therefore, if a listed company becomes insolvent, its creditors cannot target a shareholder's personal assets, although the shareholder can lose their entire investment in the company. Shareholders traditionally enjoy the following rights: the right to inspect the company's books and records, the right to sue the corporation for misdeeds of its directors and/or officers, the right to vote on key corporate matters such as naming board directors and deciding whether or not to greenlight potential mergers, the entitlement to receive dividends, the right to attend annual meetings either in person or via conference calls, the right to vote on key matters by proxy, either through mail-in ballots or online voting platforms if they are unable to attend voting meetings in person, the right to claim a proportionate allocation of proceeds if a company liquidates its assets. It is a common myth that corporations are required to maximize shareholder value. While this may be the goal of a firm's management or directors, it is not a legal duty. Let's compare common versus preferred shares. Many companies issue two types of shares, common and preferred. The vast majority of shares issued are common shares, primarily because common shares are cheaper and more plentiful than preferred shares. Shareholders holding common shares enjoy voting rights. Shareholders with preferred shares generally have no voting rights, but their preferred status means they get paid their dividends before common shareholders are paid. In addition, the dividends paid to preferred shareholders are generally larger than those paid to common shareholders. What is a corporate action? Corporate actions include share splits, dividends, mergers and acquisitions, rights issues, and spin-offs. All of these are major decisions that typically need to be approved by the company's board of directors and authorized by its shareholders. A corporate action is a move enacted by a publicly traded company that encourages or furthers processes that have a direct impact on whatever assets the company issues. In other words, any actions conducted by a company that materially alter or otherwise change the company can be considered corporate actions. Corporate actions fall into one of three categories. The action may be mandatory, where shareholders effectively have no choice in whether or not they want to participate. Mandatory with options, where the board of directors carries out an action but provides shareholders with a choice of options. And voluntary, where each shareholder decides if he will participate in the action or not. Publicly traded companies are frequently overseen by a board of directors, individuals closely tied to the company who are elected to serve in various positions. The directors approve any corporate actions taken, most commonly through a vote. Lastly, let's look at the JSE Stock Exchange News Service, or SENS. The JSE offers a service that provides the market with access to company announcements such as mergers, takeovers, rights offers, capital issues, cautionaries, sales updates, and earnings releases, all of which have a direct impact on the movement in the share prices of the companies. This service is called Stock Exchange News Service, or SENS. We have come to the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in the session are purely for illustrative purposes. Thank you for your time.